Hey, what's up, everyone? Welcome back. So, this weekend was a lot. US and Israel launched strikes on Iran. Bitcoin dropped to $63,000. Social media went into full panic mode. And if you only looked at the headlines, you'd think crypto was in serious trouble right now. But here's the thing, Bitcoin is sitting at 66K as I'm recording this. It bounced, it held its levels. And while everyone was panicking online, institutional money was quietly flowing back into Bitcoin ETFs at the fastest pace we've seen since October. So today I want to break down both stories because I think most people are only paying attention to one of them. So let's get into it. So let's talk about technical analysis first. We are at $66,201. We've been grinding through this range since Bitcoin peaked at around 126,000 in October, and the drawdown down to 60K in February was a rough 52% drop from the top. Since that low, we've bounced back into the mid to high 60s. There are two levels everyone's watching right now. On the downside, there's a CME futures gap, $65,880. Those tend to get filled, so worth keeping on your radar. On the upside, the 21-day moving average at $67,627 is the first real hurdle. A clean break above that is what bulls need to see before this starts looking like a genuine recovery. If that 21-day break, some traders are already targeting 73K to 74K as the next stop. Totally reasonable based on the current chart structure. So the bear case is also worth respecting. Analyst Phil Bilbs has flagged a historical pattern pointing toward 40K to 45K if we can't reclaim 72K on a weekly close. That model has held up in every prior cycle. It's a real risk. I will come back to what I think changes that outcome in the macro section. Quick one, if you're trading at around 65K gap or the 67 resistance level, I personally use Bitunix to manage my positions. Clean platform, easy to use in setups like this. Link is in the description below, by the way. So let's talk about right now what the weekend actually showed us, because I think that the price reaction is telling. When the Iran news broke on Saturday, Bitcoin dropped 4% to 63K. About 300 million in longs got liquidated. Sounds bad, but trading firm QCP Capital hold it contained, especially compared to the chaos we saw in early February. Their point was that a lot of leverage had already been cleared out, so the shock didn't have as much fuel to cascade lower. And then Bitcoin bounced. By Monday morning, it was back above 65K. The news was still terrible, the geopolitical situation hadn't resolved, and Bitcoin held anyway. Sentiment is still deep in extreme fear territory, no argument there, but when a military strike on Iran can't push Bitcoin into a sustained breakdown below its prior lows, that tells you something about where the underlying demand is sitting. The 62K, 63K zone is now being watched as the potential long entry on any further dip this week. So this is the part I keep coming back to. Let's look at what the data is actually saying. February was brutal for ETFs. 3.8 billion in net outflows, the worst single month since launch. But last week something shifted. Bitcoin ETFs saw 3 consecutive days of net inflows totaling more than $1 billion. On-chain analysts from CryptoQuant called it the first meaningful accumulation wave since October, right around the all-time high. Think about that. Price is at 66K, sentiment is at extreme fear, and institutions put over $1 billion back in over the 3 days. Those two things don't line up unless you think institutional capital is reading something that the fear greed index isn't. EMJ Capital's Eric Jackson framed it really well. He made the point that every cycle, weak hands get filtered out at a certain level. In 2017, retail sold near 20K. In 2021, funds sold near 69K. In this cycle, ETF allocators are selling around 63K. What replaces them is longer duration capital. Institutions that aren't going to panic on the next 15% move. He called it the purification of the Bitcoin bull case. I thought that was pretty good way to put it. So for anyone positioning around these ETF signals, Bitunix is what I use for execution. Solid platform for managing trades through setups like this. Link is in the description, by the way. So now let's take a look at the macro overlay, because this week geopolitics and macro are completely tied together. The main risk right now is oil and inflation. Iran is claiming to close the Strait of Hormuz, a critical oil shipping route. JP Morgan research suggests a full closure pushes oil above $100 a barrel, which could spike US CPI toward 5%. And if inflation goes back to 5%, the Fed isn't cutting anytime soon. Right now, the probability of a March rate cut is sitting at 4.4%, effectively zero. That's the real macro risk. I want to be straight about it. The counter argument, though, and it's a strong one, is that a prolonged conflict that spikes oil and drives inflation is a political nightmare for Trump in a midterm election year. He ran on cutting inflation and reducing gas prices. Multiple analysts are expecting short contained operation for exactly that reason. Markets seem to be pricing something similar, which explain why Bitcoin recovered as fast as it did. Stepping back from Iran, the broader macro picture hasn't changed. Dollar is structurally softer. Global central banks outside the US are still easing. The long-term liquidity trend is still toward expansion. Iran is a near-term variable. The structural backdrop is still intact. And one thing I saw today that doesn't get much attention, but matters for the bigger picture, a consortium of 12 major European banks, including ING, UniCredit, BBVA, is now in an advanced talks with crypto exchanges ahead of launching a euro stablecoin in the second half of 2026. That's not a short-term price catalyst, but banks of that size building crypto infrastructure tells you exactly where this industry is heading, regardless of what's happening with Iran this week. One more, BitUnix is my go-to for managing positions through macro setups like this. Link is in the description below and it supports the channel, which I appreciate. So here's where I stand. I'm not adding new size this week, not because the thesis is broken. It isn't, but because the Iran situation has enough uncertainty that I would rather wait 48 to 72 hours and see how things develop. If we get de-escalation and Bitcoin holds that 62 to 63k zone on any pullback, that's a cleaner entry for me. That's when I would feel comfortable adding. What I already hold isn't moving. Long-term story is intact. ETFs, re-entry, dollar weakness, European banks building crypto rails, and a cycle that's historically doesn't end here. None of that has changed over the weekend. The base case is contained conflict, continue ETF inflows, and a gradual move back towards 73k to 74k over the coming weeks. This risk case escalation, oil above 100, and inflation forcing the Fed to hold longer. I hold that at lower probability, but it isn't real and I'm tracking it. What I'm watching this week is how traditional markets digest the Iran news, whether 65k holds and whether ETF inflows continue through the volatility. Those three things will tell me a lot. Drop what you're watching in the comments. I read them, and if this kind of breakdown is useful, subscribing helps me keep making it. Alright, take care. See you in the next one.